Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, November 4th. I'm Jay Gragnani, and here joining me this week is Sarah Maley. And this is our special post-election edition of the podcast. And the votes are still being tallied in a number of states out there. As a number of states, as many of you I'm sure are aware, we're certainly too close to call. And so it'll be some time before the actual results from the election are known with any degree of certainty. So we'll continue to watch that. And it's interesting as we came into the market today. When we go back and historically look at previous days post-election, so the trading day immediately following a U.S. presidential election, the numbers have been pretty interesting. There's only been going back to 1960. There's only been 40% of those days that have actually turned out positive. So in other words, the day after an election, 60% of the time has actually been a negative day for the market. As we're recording this right now, the S&P 500 is up nearly 3%. The NASDAQ Composite's up nearly 4%. Dow Jones is up nearly 2%. And there's still a little bit of trading left, but by all accounts, it appears that the markets are going to finish positive this time and after the election of 2020. And it's also interesting when you look at the numbers that since 96, so there's been this is the seventh presidential election since 96. Every one of those days following the election in the market, the S&P 500 has actually seen a plus or minus 1% move. So the days immediately following the election historically typically are more volatile days to the upside as well as to the downside. And, today we're seeing that volatility play out to the upside, at least certainly now for the time being. So, we'll continue to monitor the situation there, continue to see how the markets play out. But, Sarah, as we were talking about earlier, a lot of the things, the areas that we're seeing perform well today in today's market as there's a lot of broad rally going on across the board. A lot of the trends that we've seen, though, have been, by and large, a continuation of a lot of leadership trends that we've seen this year.
One good chart to look at, just to kind of put that into perspective, is going to be the chart of PDP. So that's the Dorsey Wright, the Invesco DWA Momentum ETF, which we've seen, pull back from all-time highs. It did reverse up yesterday with yesterday's rally, and then today has printed 3 more X's at 81. It's up a little over 4%. So 2 boxes away from another buy signal as well as a new all-time high. And so that's just showing us how our leaders are definitely still leading. And another interesting chart that I was looking at earlier is just going to be that of the QQQ, so the Invesco QQQ Trust. And you can also see this very similar pattern on the chart of the SPY. But we've seen these charts, after just being up in one solid stem from April through about September, we saw both charts start to consolidate just with the volatility that we've seen over the last few months as, we deal with the coronavirus and that's the days leading up to the election. Just a lot of uncertainty and a lot of volatility out there. So we saw just some consolidation, which formed a triangle pattern on both of these charts. But just looking at the QQQ, that actually reversed back up into X's today at 285. So that marks the 5th column there of that consolidation, which is what we need to successfully complete a triangle pattern. So from here, a bullish triangle pattern would be completed at 300, while a bearish triangle would be completed if this chart were to reverse into O's and give a sell signal. So just seeing some, these will be charts to watch as we move forward, just because these triangle patterns tend to be explosive, rather either to the upside or the downside. But I think that it's, today's move of a little over 4.5% for a QQQ is, is looking good, and we're nearing back at those all-time highs.
Yeah, and I think one of the important things there too is a lot of those triangles, the consolidations, they are coming within generally positive trends, and that's still the case for a majority of stocks out there. That we're seeing a majority of stocks still in positive trends today. That number has come down a bit from its peak back in the summer, especially for the S&P 500. But we're still looking at a reading around that 66% level or 65%, which means that nearly 2/3 of all the S&P 500 stocks are in positive trends, and that's important to just have some perspective on that. Historically, in the market, when we've seen that number above 50%, those have been generally positive market environments. When that number drops below 50%, is when that trending picture for stocks would flip to being negative. Right now, that number, like I said, has declined, but the fact that it's still above 50% is something that would be considered to be a good sign for the market, a healthy market environment when you're getting a majority of stocks in positive trends today. The other thing that you mentioned, momentum and PDP specifically, and that kind of reminds me of it. Almost got a little bit lost today and yesterday with the election, but this week, as we turn the calendar to November, as is the case every year, it starts what is historically known as the seasonally strong period in the market, and that is the period from November through the end of April. And we've talked a lot about ways to take advantage of that market seasonality idea, in that historically, what we have seen during the seasonally strong period in the market, that being from November, so starting this week through the end of April, those market environments have historically rewarded the equity market and have historically rewarded more growth-oriented or momentum-oriented strategies like a PDP versus during the seasonally weak period in the market, and that's the period that historically runs from the beginning of May through the end of October. That is historically a weak time period for the market. This year bucked that trend a little bit. As a matter of fact, it was a positive environment this year. But historically, if you go back and you look at the numbers, that period that's defined from March through the end of October, the adage of sell in May and go away, it comes from this idea that the markets historically don't perform as well during that time period. Those markets, though, tend to reward investments in things like low volatility strategies. So something like an SPLV, which is an Invesco S&P 500 low volatility ETF. And those two, momentum and low volatility, over time, they both independently have shown the ability or the potential to outperform the S&P 500, but they do so at different points in time. And so having a piece of a portfolio that is allocated to momentum and low volatility is something that we have talked a lot about, something that we do in a number of models that we run, is combine PDP and SPLV in that portfolio, because you get those two factors that independently work very well, but they have a negative correlation of excess returns, which means, in my brain, I think about it like they play well in the sandbox. And that's the whole negative correlation thing. They play well in the sandbox because they generate excess returns at different points in time. So one of the strategies, that you can build on that in terms of taking advantage of the market seasonality is overweighting momentum from November through the end of April. And then come May 1st, you don't have to sell and go away, but you simply overweight a low volatility. So we've got some models on our website that do just that. So just this week, we went from 70% SPLV and 30% in PDP over to 70% in PDP and 30% in SPLV because of the market seasonality. So if you want to dig more into that, we can look at the website. There's models that are available. We've also published a number of articles here recently in our daily equity report that talk about that idea and why momentum and low volatility work together, and why you may want to consider adjusting that on a seasonality basis going forward. So that's just something to think about if you're thinking about ways to look at the market today, some strategies that you might look to employ. That's certainly one of them. And as we look at it, even today's market, there's a lot of areas that are up, a lot of areas that are doing well. With the healthcare sector on a broad basis is among the best performing sectors, as well as technology, and then consumer discretionary. And those trends, again, those are trends that we've seen so far play out over the course of the year, with technology and more growth-oriented areas continuing to perform well and continuing to lead the market, while other areas, more value-slanted areas, financials is one that is, banks specifically are actually down today. So, so the trends that we're seeing here post, at least the day after election, Sarah, the trends that we're seeing, there are many trends that we've seen kind of play out throughout the year and are still in line with where we see strength across sectors, whether you're looking at Dolly sector rankings or a number of our sector rotation strategies.
Right. And as we move into this strong season, after finishing this weak season, and I say weak in quotations just because, like you said, we kind of bucked the trend there, which it seems like we're doing with everything in 2020. We were up, I think the Dow was up a little bit over 8%. But yeah, as we move into this seasonally strong period, it's important to remember, like you said, the U.S. equities are ranked number 1 in Dolly. We're continuing to see those sectors participate, the large growth, like you said, the high RS, like tech sectors and things like that. We're still seeing leadership there. The PT chart is in a healthy place, as you mentioned. And then, on a near-term basis, we did see the bullish percent reverse down into X's or into O's last week, where it currently sits at 46. But if from a long-term perspective, we're still seeing leadership with U.S. equities. That's still the place that we want to be. And then, like you said, with the rules-based strategies of overweighting momentum, underweighting low vol through this time of year, that just adds more to your process. It simplifies your process, I'll say, which I think over the last few days we've seen, sticking to your rules is really important. I know that I have family and friends that were expecting, as were many, expecting a doomsday type of market today. And, to see the NASDAQ up, over 4%, just shows you that, taking your emotions out of the equation is really important, and just making sure that you find a process and you stick with it.
Yeah, I think, the election of 2016 is still burned into many people's minds. And we were talking about it earlier, the day after the 2016 election, when Trump won, that seemed to shock the markets, at least overnight. And the futures were down big, down over 5% at one point before overnight. So the market hadn't opened yet, but by the time the dust settled, the markets, had recovered quite a bit, and the S&P 500 was actually up about 1% the day after that 2016 election. And that's the memory that most people don't, me included, don't think back and think, geez, the day after that election the market was positive, but it was the overnight reaction that is still, I think, burned into many people's minds in terms of expectations of what might come in today's market, leading up to that. Certainly very interesting stuff, and we'll continue to monitor the situations as we continue to go through the month of November and head into the last month of the year. But if there's anybody out there has any questions that we can help answer specifically, whether it's about individual stock, individual rankings, or how to access something like the Dolly tool that we were talking about today, please don't hesitate to give us a call. You can reach us at 804-320-8511. You can also reach us via email, dwa@dorseyright.com is our general inbox. Otherwise, I hope everybody out there continues to stay safe, and appreciate everybody taking time out of your day to join us for these podcasts, and look forward to talking to you soon. Thank you.